to our special segment, Alpha Manager. Today we feature Sunil Singhania, CIO, Equity of Reliance Mutual Fund. Sunil personally manages a host of funds, of which two of the best performing ones are Reliance Growth Fund, which has given a 65-time return in 18 years, and Reliance Small Cap Fund that's provided returns of 130% in 1 year. Good afternoon, Sunil. What a pleasure to have you on the show. Thanks very much for joining us. I'm going to start with the general question. What do you think of where we are in the markets at this point in time? There were talks of a correction a few weeks ago. Are we done with that based on the declines we saw in the recent past, or do you expect some more volatility here on?
See, I think what we are seeing is basically a start of a fresh economy upturn. That is what our view is. So irrespective of the election results, what we had seen was, you can say, a coming together of a lot of negative economic indicators, whether it was current account deficit, fiscal deficit, currency swinging very widely. And last 1 year, a lot of these have started to correct. So now the IIP numbers have started to come positive. Inflation is coming down. Thankfully for us, rainfall has picked up and oil prices have started to fall. So I think economically we are heading into a scenario where a lot of things have started to turn positive. And we always say that, India is among the very, very few countries where interest rate cutting cycle is still not started.
Yeah.
In fact, we are the very few countries where interest rates are higher than the pre-Lehman crisis rates. And we have a long way to go there. So from our perspective, that is the key positive. And with the change in government and the news flow which we are getting and the resolve which the government actually is displaying in terms of bringing the economy back on track, if the economy also starts to come back on track, then you might start to see positive surprises on the economy front, on the earnings front.
But when do you expect that to happen? Because what you're talking of now is a clear positive turn in sentiment, right? But there is a lag between the fundamentals and sentiment. When do you think? Are we at the turnaround point for the fundamentals, or are we at least a quarter or 2 quarters away?
No, Menka, fundamentals have also started to turn.
You're convinced about that?
You see IIP,
Yeah, I know, but I mean, that's a really volatile measure, so I'm not going strictly only by IIP.
No, but then you see the PMI, and then you see the fiscal deficit numbers. You see the currency stabilizing at 60, 61. I mentioned about oil. Oil staying at these levels.
So we are at turnaround point for
Definitely.
the economy.
And even on the corporate profitability front, except the capital good companies where there's a lag, you see the other companies or the other sectors. They have already started to see an uptick in terms of their growth numbers. So we're definitely there. Now, how fast we move to the next level is obviously going to depend a lot on the government policies.
Okay, fair enough. Anuj?
So, this year has been a lot about mid-cap stocks. You've seen quite a bit of catch-up from mid-caps. The index itself is up, I think, it has outperformed the Nifty by good 20% or so. And you are known to pick some good mid-caps. From here on, do you think the mid-cap outperformance is going to get exaggerated? Or do you think it will now perform in line with the large caps? What's the sense?
So, if you actually see last 4-5 years, there's been a massive sort of a two-tier kind of a market, where the top 10-20 large caps were the ones which were getting inflows and which used to trade at 30-40.
It was a narrow market.
It was a very narrow market. And that was very logical because investors were scared. So they were just trying to sort of, stick to the very, very high quality names where the news flow at least was not negative. Now what we are seeing is a renewed confidence in the economy and the markets, and therefore the rally is getting a little bit broad-based. So in mid-caps, typically you can't bucket them as one basket because every stock, every sector is very, very different. So there is definitely froth in some of the mid-caps. There is overvaluation in some of the mid-caps, but there are a reasonable number of mid-caps where there is still value left. And I think that is where we are going to focus on. And one very clear thing is that investors have been trying to chase the 10-20 rupee stocks. I think this is advice to them that just don't go by the price of the stock, because you'll end up buying stocks which are there at 10-20 for some reasons.
Yeah.
So I think apart from that category, we feel that there is definitely opportunity in a lot of them.
Okay, so I'm just looking at some of the stocks, and obviously you may not want to comment on them, but for example, your diversified power fund has a lot of these mid-cap names which have done reasonably well. Do you get any temptation to lighten up some positions here, or book some profits here and to re-enter later, or do you think these stocks are good for more from here on as well?
See, from a portfolio perspective, every day we tend to do something because that is what we have paid for. But just because the stock has moved up, will we sell? We will not. I think our job is to see the best use of money at that point of time. So in case we feel that relatively there are better stocks which we can invest in, obviously there is a sense in shifting out of it. But just because the stock has moved up, we'll definitely not go out of it. Specifically on the power side and power equipment side, there is a lot of questions that, the P's of specifically the power equipment companies are very high. However, we are seeing P's based on the immediate past profitability, which is not a true reflection of the actual earning capability of those companies. So our view is that as the ordering improves and as the execution improves, these companies have huge operating leverage because they are operating at 50-60% capacity utilization, and therefore the earnings can surprise on the upside. So I think in these kind of companies, we are very clear it is very difficult to buy quality companies once you are out of it. So we would resist the temptation of trying to make 5-7% by selling and trying to buy back.
I've got some of the power companies listed here, and I was just wondering, Sunil, have you preferred the power input guys more than the generation guys? Is that how you look at it? Because off that list, you've got KEC International, PTC, ICICI Bank, L&T, Cummins, Crompton Greaves, Tata Power, Thermax, Alstom, Reliance Power. It seems like generation is a far smaller part of the portfolio.
So on the generation side, frankly, there are only 4 or 5 private guys who we believe will survive. So if you actually see, we are
trying... You want to name them for us?
They're all there.
Okay.
So what we're trying to basically focus on is the larger guys because we feel that the balance sheet will be, will take care of their survival.
Okay.
Some of the smaller guys who have gone into power, they might feel a lot of stress in meeting their debt obligations and they might not survive.
So you're saying the group balance sheets will help
will definitely
sort of salvage, whatever.
And on the equipment side, a lot of these companies are either debt-free or very reasonably placed as far as debt is concerned. And that is why I said, we would rather focus on operating leverage than financial leverage.
Okay.
So usually financial leverage companies will tend to avoid. Try more to, focus on the huge operational leverage plays.
One of the stocks that seems to feature in your top 10 holdings for quite a few funds is Aditya Birla Nuvo. Can you talk about it a little bit? I'm not asking for price targets, etc., but what appeals to you in that company so much?
See, actually, if you see, India is a huge country, 1.2 billion people. Now, there are various ways of playing this. One is obviously this huge savings boom, which you can play through the financial services. Then there is this huge aspiration boom, which you can play through branded plays. And then there is, the third element, which is data and, mobile and mobility and all. So I think that will answer why we are bullish on a few companies and not. So I think we're trying to see that once India moves to the next level from 2 trillion to 5 trillion, what are the segments which are really, really going to just explode? And the good thing is we are behind the world by 20-30 years.
Yeah.
So we don't have to do any rocket science. You just have to see what has happened in the US and what has happened in Japan and what has happened in China. And the same thing is going to happen in India. So I think a lot of these plays are sort of,
So would you say that, if the next 20 years is going to be, 20 years of very high growth, all sectors will do well. What is top of the heap for you? Is it consumer-facing sectors that is top of the heap for you? Is that how you would look at it? Or financials, because they're consumer-facing as well as, sort of industry connect? What is top of the heap for you?
So financials are definitely a key area.
Okay.
Consumers would definitely be a key area. However, our view is that a lot of these consumer stocks are trading at much higher valuation than we would like them to.
Yeah.
And specifically in sub-segments where the growth is lower. So, there is a part of the consumer sort of basket where India penetration is already at 80-90%. So there the scope of high growth
that
is going to be
the traditional
limited.
FMCG basket.
Right, so the staples.
Yeah.
And then there is another consumer basket where the growth rates are going to be faster. So I think we would prefer the later.
So would that be white goods for you, durables for you in that sense? We've seen some companies do excellently well in earnings over the last 2 weeks.
So. Is sort of appliances, you can say to some extent the home decor kind of thing.
So the paints, the appliances, all those companies are where you see more of the growth coming in.
Then branded garments, branded shoes, all sorts of, because once you reach a particular level of lifestyle, you have aspirations, and that aspirations are not going to directly go to Armani. You will have many more in between.
Fair enough.
And that is where a huge opportunity would lie.
All right, we're going to take a quick break, but when we come back, we're going to talk to Sunil about what he thinks of the oil and gas spaces and what it will take for him to fall back in love with public sector banks, if at all. That's coming up right next after this quick break.